I'm Tracy Wheeler with Savvy Ladies. Thank you all for joining us today. Just wanted to give you a shout, or I just wanted to give our helpline a shout out real quick. We have our financial helpline. So if you have any personal questions regarding things covered here that you didn't want to ask, you're welcome to come to our helpline, and we'll be putting that link in the chat. But without further ado, let me introduce Ashesh and Kristen, and we'll get started. So I'm going to send it over to you.
All right, awesome. Hey everybody, I'm Kristen Bonnier. Just to tell you a little bit about myself, I live in the Tampa Bay area with my husband and my 2-year-old son. I have been a part of Savvy Ladies for not quite a year yet, but I do assist in the helpline, and I think this is really just such an awesome organization to be a part of. Oftentimes, women are completely left out of the financial planning and the finances for their families, and so I love being a part of this. I am a mortgage broker. I've been doing this for about 10 years. I am licensed currently in Florida, Georgia, and Michigan, although at one time I was licensed in up to 35 states. So I have quite a bit of experience with this. And just to tell you a little bit about today's meeting, we are going to be discussing using the equity in your home. And we're going to be doing this in 2 parts. So we have session 1 this week, and then next Wednesday, we're going to have session 2. And session 1 really is going to be about accessing the equity. So how do you get these funds out of your home? How can you do that? And then we're going to show one example today of what you can do with that. But next week really is going to be more about using the equity for those investments and making some money off of the equity that's in your home. So Ashesh is going to get us started today. So thank you all for having me.
Hey, good afternoon, everyone. My name is Ashesh Shah. I am branch manager of PNC Bank in New Jersey. I'm very close to Atlantic City area. So those people are part of the presentation today in New Jersey. Certainly, I'm very close to you guys. Let me give some brief about myself. So I've been with the bank for 22 years and in a banking for 24 years overall. I have expertise in a financial planning where I do general financial planning where debt management falls in. Along with that, I also do education planning, insurance planning, investment planning, retirement planning, tax planning, and estate planning. So any of those areas that anybody needs the help, certainly we have an assistance available. As Kristen mentioned, actually, I have been a part of this awesome organization. Savvy Ladies is doing extremely great job reaching out to those people who really are looking for specific help in a financial and financial planning area. So I am very grateful to be part of this journey. Thanks to Tracy. And certainly, if you have any question about either this subject matter or anything that you have in general in a finance, please, I encourage you to reach out to the helpline, which Tracy will provide the information towards the end of the session. So and throughout the session, if you have any questions, please feel free to kind of either use a chat room. So we will monitor the chat room. If we are able to answer those questions throughout the presentation, we will continue doing that. If not, then certainly we will roll with the presentation, and towards the end, you will have an opportunity to again ask those questions if you prefer. So, Kristen, if I can ask your help, please, let's go to the second slide. Okay, so first of all, what is the home equity line of credit? So our session, as Kristen mentioned, is a two-part. So any equity that you have in your property, real estate, it can be accessed one of the two way. I'm going to be presenting the idea of understanding the home equity line of credit, and Kristen will be working on her expertise of the mortgages. Before we jump into the actually either of the credit, I just wanted to kind of give the basics of the credit, which actually there are kind of a three C's that most of you might be aware of. But basically, anytime you are accessing credit, it involves understanding the credit score, the cash flow that you currently have to borrow money, and the collateral which is involved has probably enough equity left in the property. So having said that, home equity line of credit is about the same actually as like borrowing money. What is the home equity line of credit? HELOCs are a line of credit. Just let you use home as a collateral. What happens is your real estate has time to time value. If you kind of compare your today's property value to pre-pandemic, I believe most of us have a somewhat positive equity in the property value without doing anything or without even paying additional mortgage if you still have a mortgage left. So the market itself actually accelerated the value of the properties, and which actually helps many homeowners. So these are the best time for us to kind of use this option. And even if you have a no need line of credit, could be one of the better option to apply and get approved for. And we're gonna cover that in a moment. Uh, there are two kind of equity options available to most of the homeowners: home equity installment loan and home equity line of credit. The home equity installment loan is basically one-time done deal, so it kind of looks like mortgage, works like mortgage, but basically it is a second mortgage. So people borrow money and a bank will provide you a check at the time of closing, and once the closing is done and check is received, basically the meter for that interest rate kind of starts at that very moment. However, line of credit is little different. So basically, it comes with sometime debit card and sometime it comes with a checkbook. So you do not need to, kind of borrow money if you really have no need for that right now. Session number two next week, we're gonna go in a detail about what are the best ways to use either the HELOC or actually the cash out from the mortgage. So basically, just to give you an idea, let's say if somebody has a property value of $300,000 and they have a mortgage balance of, let's say, about $150,000. So basically, there is $150,000 in total equity left, and that's the equity against what you can borrow money in terms of line of credit. Basically, 150 would be available for you to use, but certainly we don't recommend you to go through the extremes. Kristen, may I have the next screen, please?
Can you see the next screen?
Uh, yes, it just changed. I'm sorry. Yes, thank you very much. So benefits of HELOCs. They are there are a few of the benefits. So basically, borrow what you just need. You do not need to borrow more. Let's roll with the same example of $150,000 line of credit that you wanted to get. And if you are looking for a small remodeling at a house, or maybe you are looking for additional construction in your building, or maybe just financing your kids education because you are looking for a small term loan. So all of those are different reasons, and you don't need to borrow all 150,000 at one time. Basically, it will allow you to borrow 10,000, 20,000, 30,000, whatever you need at the time, and that makes easier for you to manage your monthly repayment. So the amount of money you borrow is the actually will dictate your monthly payments. And it's a very easy formula, which in this next session we will cover how to calculate approximate dollar monthly payment on your own without using any help from the banker. Now, these payments are very, very easy and flexible, as it says. Most of the time, majority of the consumers kind of are aware of what's happening, and they really kind of budget their monthly expenses based on what their anticipated monthly loan payments. So, kind of for a long-term budgeting purpose, these HELOCs are much better option than any other choices. Now, the second bullet point, it says get annual, a lower annual percentage rate. So if you compare any unsecured loan, so that could be any credit card, any personal loan that your bank may offer you, compared to that, HELOCs are much, much a lower option. Why? Because of course it's secured with a real estate. So bank has lesser of a fear factor in terms of losing money. So basically rates are a lot more favorable to you compared to any other options that may be out there. I highly encourage you to kind of work with the local bank that you are at, or if you are looking for any additional help towards the end of a presentation, mine and Kristen's both contact information will be on the last slide where you can reach out to us directly too. Next slide, please. Thank you. Now, normally speaking, so if you think about maybe recent application that you have done for usually personal loan or even a credit card, most of the time banks have a higher limit because they are unsecured. And problem is that when they are unsecured, banks have a not as higher of a bigger of an appetite for a loss purpose. So that's why they usually limit like the bank I work, I'm going to use that as an example, PNC. The highest personal loan anybody can borrow with the best optimal credit and optimal cash flow is $35,000. But 35,000 sometime may not be enough for the project you're trying to do. So that's where HELOC comes very, very handy. And this can be done based on the equity, based on a cash flow and your credit. This can go up to $1 million. That makes one of the better kind of alternative compared to the other no, unsecure or non-secure loan option. Now, many people just use this also for increasing the credit score. Now, if your credit score in in a upper of a 750, close to, so I'm kind of using the model of a score of an 850 because there is a newer model that calculates based on a 900 score too. But let's assume that 850 scores that's there, and if you are using this line of credit and just making minimum monthly payment that is required by the line of credit, it will really actually either keep your score to the highest or optimal level, or actually you will see your score improving month after month. So you will see a positive reinforcement to your credit score too. Uh, Now, refinancing, again, it I mean, it takes in a few weeks, but recently, because of the rates were very low and very favorable, majority of the banks are taking between 5 to 10 weeks, depending upon where you are and what their application flow is. But it could be done in few weeks, and it could be a little longer than that. Most of the time, the rate that you are looking at is usually associated with something called prime rate. So I'm going to step back to move forward. Most of you may be aware of the Federal Reserve banking system that kind of sets the tone of interbank rate, and based on that, banks creates something called prime rate. Uh, uh, in a news last week, federal chairman actually said that he is kind of increasing prime rate by 1/4%. So based on that rate, actually most banks also increase the rate. But just to give you historic numbers, the prime rate range, the lowest, as low as possible, of 3.25%. That was before a current hike, and it went probably about 15% in the mid 80s. Now, all of your credit card rates, all of your unsecured debt, including the home equities, are based on those prime rate. So one of the uneasiness that happens, let's continue with the same example of borrowing 100 or getting 150,000 line of credit and borrowing 10,000 from that line of credit. Now, if we are on a fixed budget and if we are looking for a specific monthly payment, the increase in a prime rate will also ultimately increase the monthly payment, and that's something is not kind of a great welcoming news for many of the fixed income families. So in that case, some banks like my bank PNC offers a locking in a fixed rate, and this fixed rate will be the fix for the term that you choose. So let's assume that we are borrowing $10,000 and you wanted to fix it for whatever fixed rate option at that time. Basically, that rate for 10,000 will remain exactly same no matter what Federal Reserve rate hikes happen. And that will be a kind of a rate running out along with the time when the loan or that 10,000 is paid off. Now at PNC Bank, to do that fixed rate, we do charge $100 locking fee, but that's just a one-time deal. And just to give you an idea, between now until end of a next year, just to control the inflation, government is, or not government, the Federal Reserve is actually looking to add additional 9 rate hikes. If each rate hike is, let's say, only 1/4%, that will add additionally 2.25%. So the prime rate will jump to almost 5.5%. So that means subsequent your credit card interest rate will go up. And so the HELOCs, because these are all variable rates. So fixed rate loan options are much better choice compared to anything else that you might wanted to get. Next slide, please. Okay, so let's understand. Of course, the picture looks rosy when you look at the borrowing, but of course there are risks associated with that. The primary risk is, of course, the risk of losing home, and this is an extreme risk, right? So that not that everybody who borrows money is losing home. So I really don't want any of us to walk out with the idea that if I apply for a HELOC, I'm not gonna be able to maintain my ownership. That's not the case. What happens is anytime you borrow money against your home as a collateral, then there is a possibility that if a family is unable to make payment, there is a possibility that the home may be foreclosed based on the terms and conditions attached with the loan. Now, we did discuss variable rate change. So, like if currently with a 3.5% prime rate, if let's say for $10,000 monthly payment is about $120, and if the same rate changes to now 5.5%, that monthly payment changes to probably another $30 more. So that variable rate change may add a lot more pressure on your fixed budget if you are considering for HELOC. And that's something you might want to discuss with the banker or the financial planner or advisor that you are working with. And tax deductibility laws have changed. So in 2017, the law was signed, Tax Cut and Jobs Act, and this law kind of eliminated a majority of the tax benefit of the interest deduction from this HELOC. Now, certainly, I am not the qualified person to kind of give you advice for the individual tax situation. I would highly encourage you to talk to your tax consultant, and probably they will be able to give you a lot more detailed version because they know your taxes, they know your income, they know your current finances. They're going to be able to give you a lot better version of your tax impact if you were to borrow money through the HELOC and whatever interest incurred through that. So that's something I highly encourage again to work with your tax advisor. So kind of that's part of my part of a presentation. I'm sure many of you have many questions. Please either put in a chat box or just write it down until we go towards the end of a presentation. And Kristen is going to start her part of the presentation, especially borrowing through mortgage. Kristen, thank you.
Sure. Hey, everybody. I'm Kristen Bonnier. I'm a mortgage broker for those that missed it at the beginning. I work with people that want to refinance existing mortgages or take cash out or purchase a home. So today we really wanted to compare the ways to take the equity out of your property. So number one was the home equity line of credit. And the second way that you can do this is through a traditional cash out refinance. So this is going to tap into your property equity in one lump sum. So if you have a mortgage balance already, we include that in there, and then we add in the cash that you need to get for a total of one new monthly payment. We do a lot of these refinances for home improvements, to pay off debts, to make other investments. People want to pay for college. All of those reasons that Ashesh mentioned, you can use also through the cash out refinance. So it's just your standard mortgage. You can get different terms available, but that is going to be a one lump sum, one-time close type of financing. So the benefits of doing it as a cash out refinance are going to be your fixed rate and your fixed payment. So unless you're getting some type of adjustable rate mortgage, which really right now is not that popular, you're going to get a fixed interest rate that is going to stay the exact same throughout the entire term of the loan. That principal and interest payment will not change. If you have a 30-year mortgage or you're getting a 30-year mortgage, your principal and interest are going to stay the same every month for the next 30 years. These terms just, they do not change. So that's the nice thing about getting a cash out refinance. Another benefit of it is you just have one monthly payment on your property instead of the two payments. And like I said, this is going to be paid off over a set period of time. So mortgages do have different terms available depending on what you can qualify for. We can do a 10-year, 15-year, 20, 25, or 30 are the most traditional, are going to be a 30-year or a 15-year. Some lenders will also offer off-term limits. So if you have 27 years left, let's say, and you want to keep it at 27, there are some lenders out there that can do those off-term types of mortgages. Another thing that's great about doing the cash out refi is they tend to be a little bit more flexible than some other options. For example, I can do mortgages down to a credit score of 500. Now, normally to get prime rates and the most cash out, you are going to need to qualify for it on a credit and income basis. So the two most important things when you're getting a loan are going to be credit and income. We can do some credit repair sometimes, but ideally for when you're getting in a mortgage, the best top tier credit is going to be 740. So anything above 740 doesn't usually make a difference in the pricing, but we can do these loans down to a 500 credit score. FHA and VA does those, and then you have some kind of non-QM sort of out of the box programs that will also do that down to the 500 credit score. The other piece to qualifying for a cash out refinance is really going to be the income. This is probably the most important part, the ability to repay the loan. That's the number one thing we're going to look at when you're going to get a mortgage. I did mention, we have some stated income and things like that, no ratio loans where you don't need to show any income. There's some investor loans available that you could do where as long as the rent payment every month covers the mortgage, they qualify that way. But traditional conventional mortgages, cash out refis, they are going to look at your monthly income versus your monthly debts in order for you to qualify. The drawbacks of getting cash out refinance, you're going to need an appraisal. I know sometimes on home equity lines, you don't always need one. You don't need one necessarily 100% of the time in getting a traditional mortgage, but in most cases, especially when you're taking cash out and trying to tap into that equity, you're going to need to get an appraisal done. And we will lend up to 80% of the home's value. So that includes any other mortgages that you have rolled in plus the cash out. So 80% of the value is what your maximum new loan amount can possibly be. The other drawback is they usually have a little bit higher closing costs than home equity lines of credit. I know sometimes banks will do no closing costs, home equity lines and things like that. This you are going to have title fees, state taxes, and other things like that that are rolled into the loan. They don't come out of pocket, but traditionally they are rolled into the loan, and usually your only out-of-pocket cost for a refinance is an appraisal. I know in my area, appraisals costs are around $600, but that can vary widely depending on what type of property you have, what state you're in, and things like that. So that's the third most important piece besides the credit and the income is really going to be the collateral, the property that you're financing that we have the loan secured to. So the value there is very critical to the refinancing piece, especially if you are looking to max out and take out all the equity that you can up to that 80%. This does also take a little bit longer usually than a home equity line of credit. On a best case scenario, you're looking at a couple weeks, but usually it's around a 30-day process to get the refinance done. My average time right now is about 25 days. Just because there's a lot of parts that have to go into it. We need to get an appraiser out there. And right now in most markets, appraisers are extremely busy. So they're taking a couple weeks usually to come out there. We do have to order title work. We need to do title searches and make sure there's clean title on the property, no construction liens or anything else from the home's past that might pop up that would put us in a more difficult position. So title, appraisal, and those are the two other pieces that we usually are waiting on. Your loan also has to go through underwriting where someone is going to check off on your monthly income and the credit that we talked about. So they review, the typical documents that you're going to need when you're doing a cash out refinance are going to be your last 2 years of W-2s, your most recent pay stub, mortgage statement. We need to see a tax bill, and we need to see proof of homeowner's insurance. So those are the basics to get it done. Now, if you're self-employed or something like that, we definitely need more documentation, including tax returns, potentially even business returns if you have something separate like that. So 1040s and then any K1s and things like that if you're self-employed. If you are doing the investor type of loan, if you have an investment property that you're looking to tap into without any income documentation, the way that we make that work is we get an appraisal on the property. They order what's called a rent schedule with it to tell us what is the market rent on the property for that area. And like I said, as long as rental income covers the monthly mortgage, then they're approved that way. I mentioned a few reasons to take cash out of your property, but besides home improvements, the most popular reason to take cash out is going to be using your equity for debt consolidation. I do a ton of these types of refinances because you can really save huge money every month by rolling in, if you have some really high balance credit cards. I've rolled in cars, motorcycles, recreational vehicles, everything like that to consolidate your monthly payments. And if you have a high interest credit card, charging 15, 20% a month, and you're making the minimum payments, those payments are only going to continue to go up every month. So paying those off and consolidating them to a fixed rate of maybe, 4%, 3, 4, 5%, anywhere in there is going to save you a lot of money in the long run. Now, obviously, the trick to that is not racking them back up, right? Because, we can pay off your debts all day, but if you're just going to continue to rack them up, it's not really worth it. So really want this to be a one-time cleanup type of thing. If your debts are getting out of control, you need some more cash flow on the monthly basis, then this refinance can be a really good thing for you to pay those debts off and save some money every month. So I'm going to give you just a little bit of an example of someone that I've worked with recently to do a debt consolidation. It was a husband and wife. They purchased their home barely 3 years ago for $400,000. They currently owe about $368,000 on it. And 2.5 years later, it's worth $512,000. So in the Tampa Bay area, last year alone, our properties appreciated over 20%. That's extreme case. Generally, when we're looking historically at the appreciation of properties, it's usually around 6%. But properties across the country right now are appreciating at a very rapid value. So this is a great time to do a debt consolidation loan if you have some other high balance credit cards and things like that. All right, so back to my scenario. Their home has appreciated about $112,000 since they bought it 2.5 years ago. They have about $30,000 in additional debt. So it's credit cards. I think they had like a Peloton or something like that on there. So a lot of different bills that they had, but they had their mortgage payment at $2,850 a month, roughly. They had a personal loan out there for almost $14,000, and they were paying a pretty high amount on that per month at $1,329. And then they had a car at $17,344 was the balance there. And the monthly payment was about $478. So their total monthly output on just these bills alone were over $4,000, $4,655. So we looked at using the equity to consolidate these debts and save them some money every month. After you roll in the closing costs and all of that, their new mortgage balance was $409,600. We combined these debts and rolled in about $10,000 in closing costs. Now, this was on the higher end. Generally, title insurance and tax stamps, county stamps, things like that, that get rolled into the loan are based off of your loan amount. And usually they're set by the state that you live in. So that includes also a new escrow account. When you do a cash out refinance, you get a refund from your current escrow account. So that's your taxes and insurance that you pay on a monthly basis. Your mortgage company holds those in escrow until your taxes and insurance become due every month. So you get a refund of that escrow account. But when you do a refinance, we do have to rebuild up that escrow account. So that $10,000 did include the escrow rebuild, but they did receive a check back for a portion of that. Another nice thing is typically you miss one payment when you refinance. So for example, if you close your refinance in March, your first payment is not due until May. Now they are collecting the daily interest in that, so it's not necessarily a true skip of a payment, but you do have one month where you wouldn't have a payment due. In this scenario, once we rolled in those costs, their new mortgage payment was $2,593, and this saved them over $2,000 a month just by combining these debts. So that for them, that made a huge difference. They could do, they went on vacation. They're not living paycheck to paycheck anymore, and they were extremely happy about this. So saved them tons a month by using this equity into debt consolidation. It's one of my favorite things to do for people. It's really gratifying for me to see how much we can save them every month, and people are really happy about this. They save $2,000 a month, but that only cost them about $500 in an appraisal. So it was totally worth it for them to do this. That's all I really have on cash out refinances. We're going to have a lot more to talk about next week with using the equity for the home for investments. But again, if anyone has any questions about this, I'm happy to talk about it, talk it through with them. This is my contact information down here, my phone number and my email, and we will take some questions down. You can put them in the chat or go ahead and shout them out.
Hey, Kristen, so we do have a question from Megan. Megan asking, is a home appraisal necessary for the HELOC application? Could you please tell us about any other requirement for the HELOC application? And I'll take that question. So Megan, great question. Yes, it is actually required, but most of the time, as Kristen mentioned, majority of the time, the appraisal is not paid by you. So I can again share information about my personal banking and my employer at PNC. We do not charge any appraisal. So any closing cost that actually happens, our customers end up paying zero as a closing cost. So I'm going to actually take this moment to kind of compare both of the solutions that's available in front of you, kind of give you a better idea. So when it comes to appraisals, yes, actually, whether you go through a HELOC or even cash out refi, both of them require appraisal, but the costing may be a different factor. So next kind of a comparison is a closing cost. So yes, cash out refinance may require a large closing cost, but the best part about that is actually you can roll everything into part of the package, so you do not have to come out of the kind of out of pocket expense versus there is no closing cost in a HELOC. And one thing that cautionary note, if you are kind of refinancing your existing mortgage with entirely HELOC, one thing I wanted you to know that there is no escrow. So let's say if a family chooses to refinance, which happened multiple times in past number of years because of the HELOCs rates were very low. So when you refinance existing mortgage with HELOC, you are responsible of paying your own insurance as well as your property taxes. So HELOCs are not allowed to kind of collect the escrow payment from any of the borrower. But I hope this answers the question.
Thank you. And we do have another question about VA loans. VA is definitely allowable for a debt consolidation. You can do cash out refinances under VA. And if you're eligible for VA, it's by far the best loan program that you can get. It's got the lowest rates and the most flexible underwriting. So I would definitely recommend looking into your VA debt consolidation. Do we have any other questions? All right, kind of looks like that's it.
Any questions? So their information is on the screen. We also have recorded the program, so we'll be sending the link out to that. And if you had a question of a personal nature that regarding any of this, you can feel free to reach out to our helpline. Also, our helpline will cover any other financial planning questions that you may have. And both Ashesh and Kristen are amazing volunteers. I do see some more volunteers in the audience. So thank you all for attending. Last call for questions before we go. Let's see, looks like, yep. Hi, Carly. Carly is another one of our volunteers. Getting some thank yous. All right. Well, with that, I think we will end. And again, if you would like to use our helpline, let me just put it in the chat again. And thank you so much
Tracy,
for joining. Go ahead.
While you are doing this, I really wanted to encourage everyone to attend the next seminar, because I think so continuation to this, they will have a lot more additional information about the possible use, and there is unlimited kind of usage available. So I really hope all of you are able to participate next week too.
Yes, and so the next session is on the 30th at 1 p.m. If you haven't registered, you can do that now or reach out to us if you need the link. All right, well, thank you everybody for attending.
Thanks, everyone.
Thank you. Bye-bye.